clear up the top two questions that are frequently asked about being taxed on your stock investment, starting with, will I be taxed on my stocks if I don't sell them? The short answer to this question is no. But to add more context, you have to understand the differences between realized and unrealized gains, which are terms used to describe the status of your profits or losses. Realized gains refers to profits made from selling a stock. If you sell a stock for more than what you paid for it, the difference is a realized gain, and you will be required to pay taxes on that gain depending on how long you have held onto that stock along with your current tax bracket. While unrealized gains refers to profits that only exist on paper but have not yet been realized by the selling of the stock. For example, if you bought a stock for $100 and the value increases to $150, you will have an unrealized gain of $50. Unrealized gains do not trigger a tax liability until you actually sell the stock and realize the gain, whether you withdraw the money into your bank account or leave it in your brokerage account. And the second question is, how will I be taxed on my stock gains? To simply explain this, you will be subjected to capital gains taxes and will be taxed based on how long you have held onto that stock before you sold it. If you sell a stock that you have held onto for less than a year, which is considered a short-term gain, it will be taxed as ordinary income at your marginal tax rate, which can be as high as 37%. However, if you sell a stock that you have held onto for more than a year, the capital gain is considered a long-term gain and will be taxed at a lower rate, which can range up to 20% depending on your tax bracket. That's why it's advisable to hold for the long term. And to give you something else to think about, capital gains can be offset by capital losses. So if you ever sell stocks for less than what you purchased them for, this can help offset any stock that you have sold at a profit. For example, if you sell stocks that have increased in value, and let's just say they generated a $50,000 capital gain, and you sell other stocks that have decreased in value and have generated a $10,000 capital loss, your net capital gain will be $40,000, which you'll be taxed on. So in these cases, capital losses can be beneficial, which can create deductions to lower your taxable income.